So this is basically a presentation of results of research we've recently conducted at the Institute. It revolves around financing constraints, and here particularly it deals with the role of financing constraints for innovation. And as has been highlighted already, the regional focus is on Central, East, and Southeast Europe plus the Commonwealth of Independent States, and it provides firm-level analysis. In case you're interested, a related working paper has already been published a couple of weeks ago. So for further reading, for further discussion, please refer to the working paper, and the reference is given at the end of the presentation. So generally, theoretically, as advocated by Schumpeter in the 1930s, but also as has been corroborated since, empirically, innovation is a key engine of economic growth, both at the firm level, but also at the macroeconomic level. So in this respect, innovation is important for policy and has therefore become part and parcel of national, but also supranational initiatives. On the one hand, to address economic ills, like low growth and high unemployment, in the context of job-rich growth. But on top of that, it's also considered to be important to address and hopefully partly mitigate societal challenges, like environment in the context of low carbon green growth, for instance, energy, aging society, and the like. However, innovation is subject to obstacles, and one of the key obstacles are so-called financing constraints. And the argument goes as follows. So generally, innovative activities are cost-intensive and risky. They're cost-intensive in the sense that such innovation projects require huge amounts of funds. And they're risky in terms of outcome. So at the beginning of the innovation project, it's not clear whether at the end something profitable, something marketable will eventually materialize. So in this case, the cost intensity, of course, raises the question of how to fund the whole thing. And innovators often encounter that they have insufficient internal funds. So in that case, they're forced to look for additional external sources in capital markets. Here, however, and that's where how financing constraints come in, they often encounter so-called financing constraints. And this is the result of so-called information asymmetries between the fund-seeking innovator and the uninformed outside investor. So basically, the investor is not able to collect sufficient information to assess accurately the riskiness and the profitability of the project. So he basically imposes financing constraints instead of increasing interest rates, which would negatively affect the riskiness of the loan pool and therefore the profitability of the whole pool. And so sort of faced with financing constraints, then innovators often feel forced to either postpone, scale down, or in the worst case, abandon their innovation projects, which of course has negative repercussions for growth. So this is basically the context of our research. So we try to establish the role of financing constraints for innovation. Geographically, we look at the group of Central, East, and Southeast European countries, plus the Commonwealth of Independent States, including Ukraine. Because for these countries, financing constraints through their negative effect on innovation further and unnecessarily retards any catching up processes with the rest of Europe. We also explicitly account for the role of the global financial crisis. So we take a comparative approach and we compare the pre-crisis period with the post-crisis period. The pre-crisis period in our case is referred to as bubble phase. It refers to the fiscal year 2007 and is characterized by an unprecedented credit boom that was fueled by rather lax global monetary policy and the easy availability of liquidity that was relatively cheap at that time. That also gave rise to partly substantial housing bubbles, particularly in the Baltic countries, and a sharp rise in private sector debt that was to a large extent denominated in foreign currency. The crisis phase, which in our case refers to fiscal year 2010-11, was characterized by a temporary collapse of net capital inflows into the region, this dramatic slump in trade, both nationally but also internationally, and the associated slump in demand, a partly dramatic slump in real GDP growth, again, predominantly in the Baltic countries, and soaring unemployment rates. In terms of financing constraints, we differentiate between two different types of financing constraints. On the one hand, the so-called credit constraints, which is something that's basically very dominant in this line of research. It refers to situations when banks outright reject credit applications. On top of that, we also look at something that's called discouragement or discouragement effect, which has so far received little attention in the literature and basically refers to situations when entrepreneurs, despite the need for external funds, do not apply for bank loans. And the reasons will become apparent in one of the ensuing slides. Data-wise, we use the so-called BEEPS survey data, which is an abbreviation for Business Environment and Enterprise Performance Survey. It's a joint initiative of the World Bank and the EBRD and focuses on so-called emerging and developing countries. So in this respect, the comparison between the EU 15 and some of the countries in this sample is impossible, unfortunately. It collects information about firms' business environment and captures how respondents perceive the business environment. So in this case, it's highly perception-based, and also how they perceive changes over time. And what is important in our case, for our line of research, it identifies obstacles to firm performance and growth. But obstacles may range from, for instance, finance, labor markets, the relationship between the state and the private sector, for instance. It's a firm-level survey that's standardized across countries. It's based on face-to-face interviews with managers, owners, or directors of firms, and repeated every 3 to 4 years for continuity. It's representative of the non-agricultural private sector, and just a piece of additional information, the samples are stratified by firm size, industry, and region. So when it comes to innovation strategies, in a very simplistic perspective, we can differentiate between two different innovation strategies. On the one hand, the so-called RM-based innovation strategy, which is sometimes also referred as the MAKE strategy, since entrepreneurs, through their R&D investments, make something new, a new product, a new process, or a combination thereof. This is the dominant strategy in so-called advanced economies, and is typically captured in terms of R&D expenditure as % of GDP. And here just some numbers as reference. In the EU 15 advanced economies, R&D expenditure share is about 2 to 3%. In the EU CEE, it's between 1 and 2%, and the Western Balkans and the CES, it's even below 1%, which of course gives the impression that in these countries there is no innovation going on, right? However, this of course ignores the second type of innovation strategy, the so-called machinery and equipment-based innovation strategy, also sometimes referred to as buy strategy, because entrepreneurs invest in machinery and equipment to buy know-how and innovation and technology embodied in machinery and equipment. And it's considered the key strategy in so-called catching up economies. And this is actually something we also find empirically proven in our firm-level analysis. So here we have the prevalence of innovative firms and non-innovative firms for 3 different country samples for the pre-crisis periods. So the top portion refers to the share of firms of the total firm population that do not innovate in that particular year. And what's interesting and sort of promising to see is that the majority of firms in each of the 3 country samples is innovative in one way or the other. In terms of particular strategy, it also shows that when we differentiate 3 different strategies, the so-called make-only strategy, the buy-only strategy, and the combination thereof, we see that the so-called M&E-based innovation strategy, the so-called buy strategy, is the dominant one, irrespective of region considered. So that basically confirms that the region is technologically lagging and predominantly relies on M&E-based type of innovation strategies to produce something new. When we look at the crisis effect, we see that there was a tremendous discouragement effect as a result of the crisis. So the top portion of each bar basically expanded dramatically in each of the 3 country samples, which highlights that as a response to the crisis, the prevalence of innovators decreased substantially. And interestingly, it all goes to the expense of so-called both strategies. So the M&D strategy still remains the dominant strategy. However, this expansion of non-innovators goes at the expense predominantly of both, but also to some extent of the R&D innovators only. Then, importantly, financing constraints. Here we look at the total sample of firms and sort of differentiate between firms that applied for credits and those who did not apply for credit, and then basically looked at the outcome. So we can differentiate between 4 different outcomes. So firms that applied and received a rejection are credit constrained. That's the bluish part of each bar. Then there are firms that applied and received an approval, which is the light grayish part. Then there are firms that did not apply and also did not have any need, which is the top dark grayish part. And then finally, those firms that did not apply but would have needed funds, which is the orange part at the bottom of each of the 3 bars. And what's, again, interesting to see is that in each of the 3 country samples before the crisis struck, there is a substantial portion of firms that basically had no need for any external funds. Right. Then there is another quite substantial portion that successfully applied for loans. And then the 2 top elements, the bluish part and the yellowish or orange part, together sort of represent the extent or the prevalence of financing constraints. And here we see that, for instance, in the EU CEE, 20% of firms from the total population encountered some financing constraints. And that goes up to about 30% in the CS countries. So that basically highlights in the EU CEE, every 5th firm encountered some financing constraints, whereas in the CS country, every 3rd firm encountered some form of financing constraint. Now, when contrasted with the post-crisis phase, or when sort of the effect of the crisis is factored in, we see many interesting things, I think. On the one hand, the portion of firms that reported that they had no need for any credits increased again substantially, which is nothing but the result or the response to this dramatic drop in demand, and therefore the lower need to invest in general, either in R&D, M&D, and other type of investment activities. Also, this light grayish part shrank to some extent, so that also highlights that there's a strong discouragement effect. So entrepreneurs were also less inclined to apply for credits. Why? Because they looked for alternative funding sources. They sort of adjusted their funding strategies to the given situation, more towards retained earnings, but more importantly, more towards overdraft facilities and leasing became a very important part during the crisis. And what's interesting to see, and what was sort of a big surprise for us also, is this sort of rather stable prevalence of financing constraints. We would have expected a dramatic increase of the prevalence of financing constraints, but this is something we do not observe for the 2 aforementioned reasons, right? Drop in demand, lower need for investments, and this change in the funding strategy. Now, go back. When it comes to the composition of the 2 of financing constraints in general, we see also an interesting pattern. We see that that's also partly surprising, this relatively little importance of so-called credit constraints. We would have expected something more dominant, something more important. And then when the crisis struck, what was also interesting to see is that actually this negligible element, namely credit constraints, became even less important during the crisis. So there was sort of a return to the normal. The crisis phase was an extraordinary phase, characterized by this credit frenzy. So lots of entrepreneurs applied for different projects that were to some extent also less viable and therefore more likely or more prone to a rejection. But during the crisis, there was sort of a return to the normal self-selection process to some extent. Then, of course, it naturally raises the question, this large chunk of firms, a large portion of firms that would have needed funds but did not apply for different reasons. So what were the reasons, right? That could be interesting also in terms of policy conclusions. So what are the reasons why they did not apply? And we see here for the pre-crisis period, for the 3 different country samples, that when we look at 7 different potential reasons that range from, for instance, unfavorable interest rates, where interest rates are lending rates, so the base rates plus the premium, complex procedures, but also high collateral requirements, to insufficient size of loans, informal payments required, and did not think it would have been approved. That of all the 7 different given reasons, the first 3 are the key reasons that kept entrepreneurs from applying for loans despite the need, which is unfavorable interest rates, complex procedures, and high collateral requirements. Okay? And what's interesting to see that the same pattern also emerges after or as a result of the crisis. The only thing that changed is that grayish part sort of increased in importance. So entrepreneurs considered unfavorable interest rates as one of the key issues why they abstained from applying for loans. And this may come as a surprise because in the EU 15 we observed a dramatic drop in interest rates. However, here in these countries, on average, in the first 2 country samples, net interest rates were about 8% on average, whereas in the CIS countries it was more than double the size, about 17%. So it's quite high. So that's the difference between the EU 15 and the rest of the region. Then, of course, not all entrepreneurs are equally affected by financing constraints. So our empirical analysis tried to identify particular firm characteristics that render a firm more or less likely to face financing constraints. So for instance, we find that smaller firms have a higher probability of facing financing constraints for the usual reason, namely the lack of collateral, and the effect is a bit stronger in the pre- than the post-crisis period. But this is not a surprise. This is a pattern we basically observe in this line of research anyway. Then we also identified some characteristics that render firms less probable to face financing constraints. So in this respect, we differentiate between 3 different trading activities: exporting, importing, exporting, and importing. So we differentiate between 3 different trading groups. So entrepreneurs that export only, entrepreneurs that import only, and entrepreneurs that pursue both activities, exporting and importing. And for this latter group, we find a significant effect in the sense that entrepreneurs that pursue both activities are less likely to face financing constraints, but only during the pre-crisis period, whereas recipients of government or EU subsidies are also less likely to face financing constraints. What was interesting to see is that there are some hypotheses we tested that did not show up any significant results. For instance, we did not find, which normally you do in this kind of research, a negative age effect, meaning to say that younger firms have a higher chance of facing financing constraints. We find no evidence of gender discrimination. We find no evidence that, for instance, foreign-owned firms have an easier time accessing funds and therefore lower probability of facing financing constraints, or that firms with a better human capital also have an easier time accessing funds. Similarly, we look at the role of the state and the structure of the banking sector for the prevalence and the effects of financing constraints. And we do find that firms are more likely to face financing constraints if located in economies that are characterized by higher non-performing loans. So a higher burden with non-performing loans is sort of discouraging for banks to offer more loans. We do find some interesting results for something that's called bank outreach. It's defined as the number of bank branches per 100,000 inhabitants, and is a measure for the physical presence and accessibility of loans. And we also see that a lower bank outreach is associated with a higher probability of facing financing constraints, predominantly during the pre-crisis period. And then finally, which I think is good news, we do find a strong role for foreign-owned banks in the region, because during the crisis period, they substantially helped stabilize the region by providing loans, whereas domestic banks were less reluctant or were more reluctant to supply. So that brings me to the core question of our research, namely the relationship between financing constraints and innovation. Given the importance of so-called machinery and equipment-based innovation strategies in the region, we looked at this particular strategy. And when it comes to the decision to innovate, we modeled it as a two-stage process. So during the first stage, entrepreneurs decide whether or not they want to invest in machinery and equipment. And if so, at the second stage, they then decide how much they want to spend on these kinds of activities. And in a nutshell, our research basically highlights that financing constraints negatively affect both decisions. So they render firms less likely to pursue this kind of innovation strategy by around 30 percentage points. And on top of that, financially constrained firms are also spend less, 4% less during the pre-crisis period and 9% less during the crisis period, which also highlights the importance of the crisis in this line of research. So that brings me to the summary and conclusion already. So in summary, firms in the region are technological laggards. They predominantly rely on the so-called M&E-based innovation strategy, so the buy strategy. We do find evidence for non-negligible financing constraints, the strong evidence for this discouragement effect, and whereas bank rejections or credit constraints have little importance only. And we find that financing constraints are detrimental to innovation activities. On the one hand, entrepreneurs are less willing to pursue these kinds of M&E-based innovation strategies. And on the other hand, they also spend less on these activities, which of course is a major concern in terms of policy recommendations, since financing constraints sort of undermine growth potential in this region. Which brings me to possible policy implications. So financing constraints should be reduced, but subject to compliance with financial prudence, to ensure continuity in innovation activity and catching up of the region with the rest of Europe. And our analysis also points at some areas of policy intervention. For instance, investment schemes and credit guarantee schemes should be implemented or should be implemented at the broader scale because they have been implemented in the region already. In some instances, the implementation could be a bit challenging for different reasons. And then finally, and this is something that has been repeated today repeatedly, the importance of non-performing loans. There is a need for non-performing loans resolutions to basically supply more credits and meet the still increasing demand. Thank you very much.